Hello and welcome to the last episode of this series on personal finance. Till now, we have covered a lot of topics that can help you enhance your financial stability and build a prosperous future for you and your loved ones. In this last episode, let's discuss the psychological implication of finances and talk about behavioral finances. Behavioral finance is a field that combines psychology with finance to explain why people make particular financial decisions. By understanding the hidden forces that shape our financial choices, we can make smarter decisions and improve our financial health. In classical finance, it is assumed that decisions of all the investors are irrational, independent, and for their self-interest. But in practice, it is not like that. People are often irrational, make decisions based on biases, and are influenced by their emotions or cognitive errors. This is also the reason why sometimes markets do not move the way they are anticipated. Let's talk about some of the common biases that affect the decisions of investors. First one is confirmation bias, which is based on the fact that humans tend to react on the information that are easily available to them. Confirmation bias is the tendency to seek, interpret, and remember information that confirms our preconceptions, overlooking evidence that contradicts it. In investing, this might lead someone to overvalue stocks that they own or are familiar with, ignoring signs that it's time to sell. Next one is loss aversion. People tend to prefer avoiding losses to acquiring equivalent gains. For example, the pain of losing 1,000 rupees is more intense than the pleasure of gaining 1,000 rupees. This can make investors hold on to losing stocks too long, hoping to break even rather than cutting their losses and moving on. Another common behavioral bias is herd behavior. This occurs when individuals mimic the trades and trends of the broader market or a segment of investors. This behavior can lead to inflated asset prices and eventually market bubbles. Emotional finance is another common bias that plays with psychology of investors. Emotions play a significant role in financial decision making. For example, fear and greed are powerful emotions that can drive market swings and individual investment decisions, often leading to poor timing of buying high and selling low. Behavioral finance also explains why many individuals fail to save adequately for retirement. Issues like present bias, where people focus on immediate rewards at the expense of future well-being, can lead to undersaving. Now let's talk about how can you overcome these common behavioral biasness. Being aware of these biases is the first step. By understanding the psychological traps, we can try to avoid them. Second, consider automated investment rules like stop-loss orders or scheduled portfolio rebalancing to help maintain discipline and reduce the impact of emotional decisions. Finally, cultivating a mindset of long-term investment and avoiding the noise of short-term market fluctuations can help maintain focus on what really matters, which is building sustainable wealth over time. As we wrap up this series on personal finance, it's important to reflect on how much our mindset and psychology influences our financial decisions. Behavioral finance teaches us to be better investors, savers, and financial decision makers by shining a light on the subconscious tendencies that can often lead to astray. Thank you for joining me on this journey through personal finance. Remember, the path to financial stability and prosperity is a marathon, not a sprint. It requires patience, discipline, and a keen awareness of the psychological factors that influence our financial behavior. Here's to making smarter financial decisions and building a prosperous future. Until next time, stay mindful and keep investing in your financial education.
Investments in securities market are subject to market risk. Read all the related documents carefully before investing.